Happy new tax year. It's an accountancy joke. So that's right. Welcome everybody to a new tax year. For us tax geeks and people in the kind of job we do as business accountants, it's a pretty exciting time because all of your personal allowances kind of reset. So we're past the 6th of April, so we've got we're into a new tax year on the 6th, and you as an individual, so whether you're a director of a limited company, whether you are a landlord, whether you're a business owner, and in fact an individual in a job, it's all reset today. And in fact that personal allowance has gone up, so you're slightly better off this year, very slightly better off, and all of those things. But we talk quite often, and we actually did a video quite recently on the things to do just before the end of the tax year, and I think that generates quite a bit of action and excitement. But I think it's worth at this point talking about things you could do now to get you started in the best way. What can you do now to get the best sort of tax result as the year goes on? And I kind of wanted to talk about 4 people really in this video, and that's those of you that do a tax return, directors of a limited company from a business owner's point of view, self-employed business owners, and then people really with more than 2 people on their payroll, which tends to end up being limited company owners, but I think there's some things to talk about there. So before we get into it, if you enjoy these types of videos, make sure to click the subscribe button below so you get notified whenever we release videos just like this one. So let's start then with just generally people who do tax returns, and particularly landlords in this example as well for one of these tips. But just make sure now that I know it's just the tax year. As we're releasing this video, it's probably mid to late April, and actually that's very early in the tax year. For most accountants, they've only probably just got the software that's available to be able to do a tax return, but I know we've done it, other accountants have already done tax returns already at this point. So we're keen to do them, let's just say that. And the reason that you should be keen to do them, and your action point from this video, is to make sure you go away and gather all the paperwork you need. If you've got an accountant, give them the paperwork early. They will thank you for it, because nobody wants to be doing it in the rush when people kind of leave it past the summer holidays, they go on holiday and then suddenly come back just before Christmas and think, wow, I've got to sort my tax return out. Don't be that guy or girl. You want to bring it forward and get it in early. Now, if you're doing it yourself, the reason both you want to drop it into the accountant to do it early and you want to do it early is your tax bill is due on the 31st of January. Now, that's miles away, obviously, but at the same point, you want to be able to plan, what is my tax bill? Have I got enough in reserve? Do I need to earn more to pay that? You know, it's getting that sorted, especially as we've had the coronavirus issues and things like that. I think you really want to be aware of what you've got to do. Now, if you're due to pay a payment in July that you were told about last year, so if you did last year's tax return, sometimes if you've been successful, you'll pay tax twice a year. You might have a July payment. Doing your tax return early could, and I say could, bring that payment in July down depending on how you've done. It certainly won't make it worse, so it's definitely worth having a look and then just knowing what you've got to pay to do that. Now, the reason I mentioned landlords is as a reminder to everybody, if you've got a property that you've sold or going to sell in this tax year at a gain, there's a chance that you're going to have to do a special capital gains tax return, and that's got to be done within 30 days of completing that property. Now, given that the return is not simple and actually just getting it completed is a bit clunky at the moment, that is a really tight timescale. So what I would say is engage an accountant, or if you're doing this yourself, make sure you understand the process really early on. Don't leave it to the last minute and think, oh yeah, I sold that property about 3 weeks ago, because it won't get done in a week. It's too short a period. So definitely check those things out and just be aware of it. So let's talk limited companies. The first thing you're going to want to do is look at your salary as the director, especially if there's a couple of you in the business who are directors, maybe husband and wife, those kind of combos. Just have a look at where you're set up. Now, a very common efficient level this year, and the reason I'm going to use very common is because it's so specific. What is the best salary for you is so specific on your exact situation. But generally, you will see a lot of people want either, say, £735 a month, or you will see them on around £1,045 a month. Now, the reasons for those are a bit long-winded, but basically they're really good levels for the optimal kind of tax saving, ultimate tax saving around national insurance and corporation tax and personal tax, those kind of things. In fact, you could probably get even more efficient if you went right to the pounds, you know, £737, for example, but I'm a simple person. I like round numbers, and to me that always feels better. So, but yeah, there are a couple of key things there, but just check, because the personal allowances have gone up. There is a bit of a change. You might have had a change of circumstances. We did a video on the channel about employers' allowance, and we'll talk about that a bit later, but some of those, if your situation have changed, some of those limits might change on how you can best pay yourself and save yourself some more national insurance, those kind of things. So do review your salaries. That's absolute key if you're a director right now. So don't go away from this video without at least thinking about that or talking to your accountant to make sure that you're on the right salary. A couple of other points then. So because we're into the new tax year, from actually the 1st of April, bizarrely, with the company, the way the company tax works, you're open to what they call the super deduction. And I'm sure we'll do another video on this, but apart from being a really cool name, it was actually, if you bought big things like vans, equipment, like MacBooks, I don't know, they call it qualifying plant and machinery, but that makes it sound like it should be a digger or a forklift or something, but actually it's general equipment and stuff you use in the business that's going to last for more than a year, that kind of stuff. Then you're down potentially for 130% tax deduction. So what that really means is for every £1 you spend in the business, you're going to get 25p back in tax. So the whole thing's only costing you 75% of the real cost. It's a very good relief. The government have been out telling everyone how good it is, and I would use that. So again, same sort of thing you'll always hear me talk about. We'll never tell you to go and spend money to save tax, but if you were going to invest, going to get those equipment, now is a good time to do that and really maximise that relief. So that's an important one, using the super deduction, and plan that. And it's a good thing to say now, if you are planning to make these kind of investments, then thinking about your cash flow, thinking, do I actually need a cash flow plan? Now that doesn't have to be particularly complex. In fact, I'll link a blog down in the comments, and you can find it on our website, but basically you can download a template we've made for free, and it is the most simplest Excel. It's almost embarrassing, but really that's all you need is month by month, what's coming in, what's going out, and when you buy in those big things, how does it affect your cash? Are you going to have enough cash? And I think that's interesting for some businesses. They realise they could spend money and still have a good amount of cash at the end of it, even if they had a pretty poor year, but didn't really realise, and sitting on cash can kind of stunt your growth sometimes. So just bear those things in mind, plan that cash flow. You can use tools. So if you're in the cloud, you're on Xero or QuickBooks, things like this, then you can get tools like Float is a good app for this, and it plugs into your software, and you can do that kind of Excel planning, but in an app that links back and it's sort of live with your accounting system. So have a look at those things. Now, from another planning point, the other thing to consider is VAT. Now, if you're not VAT registered, obviously you want to keep an eye on two things really. One, could I be? Because you don't have to wait. So there's a threshold at £85,000 where generally for most businesses you're going to have to be VAT registered. But you can register, again, in the majority of cases, below that line. But if you get to a point where you have to register, that's a different thing. So the two things to track are, one, track, should I be registered early? And we'll talk about that in a sec. And secondly, do I know where I am with my sales so I don't get caught out with registration? And I know we've done plenty of videos on this on the channel, but you need some sort of think about, do I need, if I know I'm going to get near that 85K, what am I doing to track those sales? Have I got a spreadsheet? Have I got a piece of accounting software to do that? Those kind of things. That's a massive, massive one. But flipping it back, just think about, and it's probably a good idea to get professional advice about this if you don't already work with an accountant, but should I be VAT registered? Because in some situations, let's say you do business to business services, you're a consultant or something like that, and you're dealing with just big businesses that are clearly going to be VAT registered because they're doing over £85,000 a year, then in many of those circumstances, you might be better off being VAT registered voluntarily. So, and that's going to bring you some money in. And getting that right at the start of the tax year can help you, improve those savings right now. So do consider that. And finally, on a company point of view, consider if you want to pay into a pension. So as a limited company owner, there's a few different ways you could pay into a pension, but a particularly efficient way often to do it with the company is for the company to make some contributions to your pension pot via its contribution. It sort of doesn't go against your personal income. The company gets a tax deduction on it. It's very efficient. So, and you have actually got nearly all of your kind of company year to make that kind of decision, but I think it's now worth thinking when you're looking at your cash flow planning and all these other things and thinking about the year ahead, think about, do I want to contribute to a pension? If you need some specific advice on whether that's good as for you as an individual, find yourself an independent financial advisor to talk about those things. Us mere accountants aren't the people. We can tell you what's the best idea for tax, but it's a regulated piece of advice that needs to be done by an independent financial advisor. But check in with those guys. They're great, and they'll be able to sort of plan whether that's right for you. So, but do consider that about now. So as a sole trader, what do you need to do? Let's talk that. I think there's a couple of things that for a sole trader, and we've covered a couple of them. One is track that VAT. If it's the VAT threshold, make sure you've got a piece of software. If you are going to get close to the 85,000, that's there. Obviously consider whether it's a good idea to go voluntary. As we've already said, if you need to voluntary register because it would make sense for you financially, great. Look at those kind of things. And then also same deal, if you're looking to invest in equipment and things like that, make sure you're cash flow planning over the year. Unfortunately, You don't currently qualify for the super deduction, the 130% tax deduction, but you still get 100% tax deduction in that first year. So it's still a very good relief. If you're looking to buy things, you're still going to benefit if you needed them. So do check that out, do plan it. Those kind of things are the key pieces. But more importantly than any of this, what you should be tracking, and this is why accounting systems are so important, like QuickBooks or a Xero, or even if you have to, a basic spreadsheet, is look at your profit. We're not talking about your turnover, your profit. If your profit is starting to get within a 30k type mark upwards, then I think you should be looking at whether limited is right for you. And that limit changes. It's very rough limit, but that's one that we see quite commonly works with a lot of small businesses. Is if you're in a 30k profit range and you know that mid-year, it's time to talk about changing. You don't need to wait to the end of the tax year, and that's a massive one. So do check that and do consider that, get some advice at that point. And finally, I wanted to talk about businesses with more than 2 people on the payroll. And this is generally limited company owners, but it kind of does apply as well to a degree to some sole traders with a payroll. But basically, you get a thing called employer's allowance. We've done another video on it. And what it means is that if you're starting to have to pay employers national insurance contributions on your people or on your own wages because you've set your salary level such that you have to pay that, there's an allowance of up to £4,000 a year, and I'll go and watch the video to explain all that can save you money. But you do have to, at the start of each tax year is the best time to do it, you have to resubmit what they call an EPS, an Employer's Payment Summary Report, that says, yes, I want to claim that relief. So if you've never heard of that, go check that video out, but just know you need to do something every tax year to claim that allowance. And if you're a limited company, even if there's just two directors in there is some potential tax plan and opportunities around that. It might only save you a few £100, but it's a few £100. So look at those things. And that, I would say, are most of the areas that's going to get you off to a good start. There are plenty of little things you can do, but I think for most people, they're the kind of things that are going to be of most interest. So go and review those, and we'll see you in the next video.